For 4 decades, the consensus trade for a military conflict was simple: buy bonds, watch yields fall, and collect the safe haven premium. But when US and Israeli forces struck Iran on February 28, 2026, that muscle memory failed completely. Within 48 hours of the bombings, the 10-year Treasury yield was rising. Bonds were selling off precisely when the historic playbook dictated they should rally. The bond market had delivered its verdict. This geopolitical shock was inflationary, not deflationary. The disruption to the Strait of Hormuz threatened to spike crude prices and feed directly into the consumer price index, forcing investors to abandon the expectation of a flight to quality. What followed was 4 weeks of simultaneous selling across both bonds and equities. This dual drawdown exposed exactly what massive institutional risk parity models had been positioned for, punishing portfolios that relied on bonds to hedge equity risk. The resulting carnage created an extreme performance divergence across the hedge fund industry. Several top-tier macro funds erased over $1 billion in a matter of days, while a select group of outliers surged 20% in just 2 weeks. This performance gap provided a brutal, real-time stress test for the industry, separating the few funds prepared for supply-driven inflation from those executing an obsolete playbook. The funds that captured those 20% returns share a specific documented trait: they did not react to the bombing headlines. Their capital was deployed well before the first strike occurred. This chart shows WTI speculative positioning from the CFTC Commitments of Traders report. By February 25th, days before the conflict escalated, large speculators had already built a net long position of 172,000 contracts in WTI crude oil, alongside 352,000 gross longs. This pushed speculative positioning to a 33-week high. Gross longs dwarfed gross shorts by a ratio of 2-to-1. The massive structural bet on a supply disruption was placed, verified, and on the books while the broader market was quiet. But the smart money's pre-positioned long oil trade only explains half the story. To understand why the other side of the trade, the bond market, collapsed so violently, we have to look past the mainstream media narrative that headline inflation fears from $120 oil caused the sell-off. Inflation expectations were only one component. The second driver was a violent expansion of the term premium. The U.S. government suddenly sought $200 billion in emergency war funding, widening the deficit precisely as leveraged funds were forced into technical selling to mate margin calls. Yet almost all market commentary ignored a third, critical structural force: the sudden collapse of petrodollar recycling. Historically, when oil prices surge, Gulf producers take massive revenue windfalls and recycle them into global bond markets, buying U.S. treasuries and European sovereign debt. With tanker traffic through the Strait of Hormuz reduced by nearly 70%, those capital flows were stranded. The structural buyer that historically cushioned bond sell-offs during energy shocks was removed from the board. Without petrodollar flows to absorb the new debt, bonds faced massive duration supply with no countervailing debt, turning the traditional safe haven asset into a toxic liability. This structural shift caught the world's largest institutional players entirely off guard. Their portfolios were decimated by holding static, high-conviction directional bets that assumed the old rules still applied. The immediate drawdowns were staggering. Millennium Management saw its fixed income and macro books wrong-footed, logging an estimated $1.5 billion loss in a single week. Citadel dropped roughly $1 billion as multi-pod macro exposures were crushed by the speed of the repricing. But the single largest documented error of the conflict belonged to Caxton Associates. Their $9 billion macro fund suffered a $1.3 billion drawdown, erasing approximately 15% of their assets under management in days. Caxton's structural failure point was highly specific. The firm entered the year holding a massive, high-conviction long position in UK government bonds, arguing that yields were misaligned with global peers and were destined to fall. This was the exact wrong asset to hold. The UK entered the war with the highest baseline inflation and the highest interest rates in the G7. Because their inflation risk was already so elevated, UK gilts were the highest beta short available in the developed bond market. The price action broke the long positions instantly. As inflation fears took over, the 2-year UK gilt surged 110 basis points in under 3 weeks, comfortably exceeding the Bank of England's base rate. When a geopolitical supply shock triggers a violent repricing across asset classes, holding static directional bets on falling yields is mathematically lethal. While the static bond longs bled out, a specific class of fund managers generated massive outlier returns. Pierre Andurand's Commodities Discretionary Enhanced Fund surged approximately 20% in the first half of March. Andurand's edge is architectural. His fund operates on an uncapped mandate, a deliberate design that allows him to scale risk exactly in proportion to his conviction. When Brent crude begins swinging $10 to $15 a day, his structure captures the full magnitude of the move without hitting arbitrary risk limits. In the fixed income space, the most technically validated winning structure wasn't a directional short. It was the long swaption straddle, heavily utilized by quantitative desks like Nomura.
This 3D volatility surface model demonstrates how a long swaption straddle reconfigures the risk profile. It captures realized volatility, or gamma, generating escalating profit from extreme rate swings in either direction without suffering the heavy negative carry of a naked bond short. The structure is also naturally long vega, or implied volatility. As institutional fear drives up the cost of market protection, the straddle's value increases mechanically, independent of the actual underlying rate movement. But its ultimate defense is two-way directionality. Swaption straddle holders captured gains during the initial yield surge and then profited again from the violent downside reversals caused by sudden ceasefire headlines. Systematic capture of these regime shifts protected D.E. Shaw's Oculus Fund. Their quantitative models detect the transition from a low volatility environment to a high volatility regime, instantly abandoning static positioning the moment market correlations break down. Then there is the unique architecture of Bridgewater's Pure Alpha Fund. While its peers suffered historic drawdowns, Pure Alpha survived the chaos almost entirely unscathed, losing less than 1%. Their defense relies on massive diversification at scale. Pure Alpha typically holds 30 to 40 equal-weight, highly uncorrelated risk factors across global markets. If a trade like the UK gilt short fails catastrophically, it is contained as just one of dozens of positions, with the shock immediately absorbed by the rest of the book. Portfolio architectures designed to harvest extreme variance allowed these winners to thrive while the rest of the industry was crushed by the volatility. Beyond the sophisticated macro funds and Claude architectures, the Iran war revealed a third, hidden category of market winners. A third group of winners operated outside of macro modeling and quant architecture, relying instead on raw, advanced executive knowledge. The baseline conditions for the morning of Monday, March 23, 2026, are heavily documented. The pre-market session was notoriously quiet. There was no scheduled economic data and 0 central bank speakers. This timeline reconstructing the order book reveals the anomaly. At exactly 6:49 a.m. Eastern Time, a massive, highly directional cluster of trades executes. Over 6,200 crude oil short contracts change hands in a single minute, representing more than $500 million in notional exposure, paired directly with massive equity longs. The market had no catalyst for this volume. Until exactly 15 minutes later, at 7:05 a.m., when President Trump posted a surprise announcement on Truth Social, declaring a 5-day pause on the planned military strikes. The market reaction was violent and immediate. Brent crude cratered nearly 11%, locking in instantaneous, massive profits for whoever placed those shorts at 6:49 a.m. Analysts quickly identified this specific pattern as the taco trade, shorthand for Trump announcement crude oil. It was a highly targeted, multi-million-dollar exploitation of classified executive actions. The scale of these executions proves that geopolitical intelligence is fully financialized. It allows connected entities to systematically front-run the world's most sophisticated institutional macro funds using information the public does not have. This was not an isolated incident. The evidence for systematic front-running is validated directly by peer-reviewed on-chain analytics regarding prediction market behavior. A joint academic study from Columbia University and the University of Haifa systematically analyzed this behavior, tracking over 93,000 distinct Polymarket contracts and nearly 50,000 unique wallet addresses during the conflict. Their core finding isolated suspicious wallet clusters predicting sensitive military strikes. Across these flagged accounts, the traders achieved an astonishing 69.9% win rate. In financial markets, a consistent 70% win rate on geopolitical binary outcomes is a statistical impossibility.
The study explicitly calculated that this win rate sits 60 standard deviations above the null distribution of random chance. On-chain data identified highly specific actors, like a network dubbed the 38-account cluster. This single entity systematically loaded millions of dollars in cryptocurrency into prediction markets exactly 24 hours prior to the classified February 28 strikes. The undeniable data trail prompted the introduction of the Bets-Off Act to outlaw wagers on government actions and drew severe criticism from prominent economists like Paul Krugman. Krugman offered a sharp assessment. He argued that exploiting highly classified national security strike plans for instantaneous futures profit goes far beyond standard insider trading. His explicit word for the conduct is treason. When information asymmetry shrinks the reaction window for public investors, standard asset allocation models become even more vulnerable. The 60/40 portfolio has now failed to protect capital during 2 consecutive geopolitical shocks, 2022 and 2026, as bonds and equities sold off in tandem. Surviving this market regime requires 3 mandatory adaptations: adopting long volatility architectures, securing direct real asset exposure that tracks the inflation source, and executing aggressive systematic diversification. When global inflation is driven by sudden geopolitical supply shocks and execution timelines are corrupted by advanced insider knowledge, directional conviction becomes a fatal liability. In this regime, only systematic architecture survives.